Hello, students. This is Miss Mishu, and I'd like to go over the answers to your Chapter 3 study guide with you to make sure that you understand everything that we discussed and that you're prepared for your Chapter 3 test. Question 1. After each transaction, the basic accounting equation should remain in balance. That answer is true. Number 2, a business transaction affects at least 2 accounts. That is also true. Number 3, assets plus liabilities equals owner's equity is another way to express the basic accounting equation. That is false. It would be assets minus liabilities is equal to your owner's equity. Number 4, the increases and decreases caused by business transactions are recorded in specific accounts. That is true. All right, number 5, the free enterprise system is based on the right to own property. That is true. Number 6, one of the purposes of accounting is to provide financial information about property and the rights to that property. True. Number 7, the owner's claims to the asset of a business are liabilities. And that's false. It's owner's equity. Number 8, a creditor has a financial claim to the assets of a business. And that is true because you owe the creditor money. Here we go. Number 9, an account is a record of only the increases in the balance of a specific item, such as cash or equipment. False. It is a record of both the increases and the decreases in each of the accounts. Number 10, the total financial claims do not have to equal the total cost of the property. False, they do have to equal. Moving on, number 11, if the creditor's financial claims to property total $1,000 and the owner's financial claims to property total $11,000, then the property value must be $12,000 because you add the two. Number 12, the accounts receivable is an example of, it's an asset. 13, all of the following account titles are assets titles except for B, accounts payable, because accounts payable is liability. Number 14, a business transaction that involves a purchase on account, what does that mean, is considered to be a credit transaction. So that means you're borrowing, or somebody else is borrowing, which would make it an accounts receivable, which is an asset, or if you owe as a business, accounts payable, which is a liability. Number 15, each of the following is a business expense except payment for equipment, because equipment itself is an asset. Remember, the definition of an expense is the cost of product or services used to operate the business, like rent. Okay, number 16, the purchase of a desk on account will increase office furniture because that's an asset, but it will also increase what? You as a business are borrowing on account. That will be accounts payable because that's a liability. All right, here we go. Number 17, the word equities refers to the claims against the assets of a business by both creditors and owners. Number 18, if Paul Abdu deposits $30,000 in a checking account in the name of his business, what are the two accounts that are affected? Remember, the business has $30,000 more in cash than it did, but you also want to give Paul Abdu credit for making a contribution to the business. That would be cash in bank, which is an asset, and Paul Abdul capital, which is owner's equity. Number 19. Blank are the prices paid for goods and services used to operate a business. We just talked about this. K, expenses. Number 20. Assets is equal to liabilities plus owner's equity is called the accounting equation. You need to commit this to memory. It's the foundation of accounting. 21. Income earned from the sale of goods and services is, so this is money that the business gets for selling a good or service. That's S, revenue. 22. An economic event that causes a change in assets, liabilities, or owner's equity is, we analyze these. F, business transaction. 23. What is the amount of money owed to a business's creditors? Accounts payable, which is a liability. So if a business borrows something from someone else, it's an accounts payable, which is a liability. 24. The owner's investment in the business is represented by the what account? G, capital account. 25. The total amount of money to be received in the future for goods or services sold on credit. So a customer has purchased something on credit. You don't have the money now, but you will in the future. It is an asset called accounts receivable, D. 26. Anything of value that is owned or controlled by an individual or a business is called Q, property. 27. The debts of a business are called its liabilities, N. 28. When an owner takes cash or other assets out of the business for personal use, the transaction is called a withdrawal, T. 29. Any property or item of value owned by a business is a or an asset. I don't know why I can't see this. Move it over here. Yeah, E, asset. There we go. All righty. So here's the situation. Salam Optical is owned by Ali Salam. The transactions below all took place on April 15. Match the following codes with each transaction below. So these are your options. Here's the transaction for number 30. Salam bought equipment for use in the business with cash of $1,850. So you increase the asset of equipment because the business has more equipment than it did before, but it also decreases an asset because you paid with cash, so the business has less cash in bank. 31, receive cash for an eye exam. Okay, so this means the business received revenue. So the business has more cash than it did before, but it also has revenue, which it affects the capital account. So that'll increase the asset, cash in bank, and increase owner's equity, which is revenue, Ali Salam capital. All right, 32, paid wages for optical assistants. So you had to pay the wages of the people that work for you. So you have less money, so it's going to decrease the asset, cash in bank, but that also decreases owner's equity. Remember, expenses will decrease owner's equity, the capital account. 33, made a partial payment on account for office furniture purchased earlier. So you purchased this office furniture earlier on credit. So you made a payment, so you have less cash in bank, which is an asset, but it also decreases the amount of money that you owe the creditor, which is your accounts payable. 34, billed a client for replacement eyeglasses. So you didn't get the money for it. When you bill them, you haven't received the money. Okay, so in this instance, but you will. So you have an increase in an asset called accounts receivable. Why isn't that showing up? There we go. Accounts receivable is increased and increases owner's equity because you have revenue. Remember, revenue will increase your capital account. Okay, problem 35. We're supposed to just identify what kind of accounts these are. So, number one, accounts receivable is an asset. What about computer equipment? Also an asset. What about accounts payable? That's a liability. Cash in bank, an asset. Number 5, office supplies, also an asset. Roberta Saba, capital, owner's equity. Repair tools, also an asset. Okay, so these are the different transactions that you're supposed to analyze and then write it down on the sheet that you see. The first is the owner deposited $60,000 cash in the business bank account. So I'm going to have to go back and forth between the slides here to show you what happened here. So the owner deposited cash in bank. So the business has more cash in bank than it did before, but you want to give credit to the owner. So cash in bank increases, and J.R. Boudreau, who happens to be the owner, capital, that also increases. See if I can navigate back here without this being a problem. Okay, good. Number 2, wrote a check for to pay the month's rent. So remember, month's rent is that is an expense to the business, and then you have less cash than you did before. So moving here, cash in bank decreases, so you put a negative sign, but also expenses decrease the capital account as well. Number 3, the owner invested a computer in the business. So the business has more computer equipment than it did before, so that is increased, but you also want to give the owner credit for making that contribution to the business. Come on. Oh, don't freeze on me. There we go. Okay, bought computer equipment on account. So now you have more computer equipment, but you bought it on account, which means you bought it by credit. So that will be accounts payable. So number 4 is computer equipment is increased, but also your accounts payable, which is a liability, is also increased. Number 5, received a check. What do you have more than you did before? Received a check from a customer for services. Oops, I'm going to go forward here. Sorry about that. So number 5, you received a check, so you have more cash in bank, and then the capital account is also increased. Here we go. So remember, it's increased because it's a revenue account. Number 6, the owner withdrew cash for personal use. So the business has less cash than it did before. So cash in bank is decreased, but we also have to decrease the capital account for J.R. Boudreau for the same amount because it is a withdrawal. Number 7, sold one of the computers on account. So you have less computers than you did before, and if you sell it on account, that means you don't have the money now, but you will in the future, so that is still an asset. So for number 7, accounts receivable is going to be increased because you sold it on account, but you have less computer equipment than you did before. Number 8, paid cash for a microcomputer. So the bank has less cash than it did before. I wonder if I can move this out of the way here. Oops, okay, sorry about that. Okay, so you had less cash than you did before, but now you have more computer equipment. So that's problem 36. I wonder why I can't move this. All right, so we'll move on to the next one, which is 37. Same idea, but we have amounts of money now, so that we're going to be analyzing these transactions. Number one, the owner invested additional cash in the business of $5,000. So that's an increase in the cash in bank and an increase in capital of $5,000. So you want to record that right here. So these are your beginning balances of all of your accounts. So you had $5,000, transaction one, which I just read, means you increase cash in bank by $5,000, so now you have $10,000. Nothing happened to accounts receivable, so that's still $900. Equipment is still $14,000. Supplies is still $1,500. Accounts payable is still $3,000. But J.R. Withdrew capital increased by $5,000. You add these two numbers, you should get $23,400. You paid a telephone bill of $600. So you have less money than you did before. And also, this is an expense, so you also have to decrease the capital account. So we're going to record this under transaction 2, less 600. So you have 10,000 minus 600. All these other things won't change. You want to subtract 600 from your capital account. So 23,400 minus 600 is 22,800. Transaction 3. Wrote a check to a creditor as partial payment on account. So when you write out the check, you have less cash in bank, but it also decreases your accounts payable because this is on account, means it was a liability. So again, you go down to this table and you're going to subtract cash in bank. So 9,400 minus 500 is 8,900. These accounts are not affected, so the balance remains the same. Accounts payable decreases by 500, so now it's 2,500, and your capital account remains the same. 4, bought supplies on account, 150. So you have more supplies than you did before, but you bought it on account, so the liability accounts payable is going to increase as well. So let's go to the table. I have to go 2 forward here. And then supplies is increased by 1,500, so you add those two for this. And accounts payable, you owe more than you did before, so 2,500 plus 150 is 2,650. Hopefully you're getting the hang of it. Okay, I got to go on to transaction 6. Here we go. Owner invests office equipment in the business. So that increases equipment, right? The business has more equipment than it did before. But also you want to give credit to the owner, which increases the capital. So here we go. Transaction 6, you increase equipment by 2,500. So the balance is 16,500. And then the capital account is also increased by that same amount. So the new balance is 25,600. Everything else remains unchanged. 7, completed accounting services and agreed to accept payment later. So this is accounts receivable because you did this, but you haven't received the money yet. So that's an asset. But also, that's revenue coming in or eventually coming in, so that also increases your capital. So here's number 7. Accounts receivable is increased by 900, and so is J.R. Withdrew capital. So 900 plus 900 is 1,800. 25,600 plus 900 is 26,500. These other accounts remain unchanged. Transaction 8, withdrew cash from the business for personal use. Okay, so the business has less cash than it did before, but also this is a withdrawal, which decreases your capital. So on this transaction, 9,200 minus 2,000 is 7,200. Unchanged, 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 unchanged. But J.R. Boudreau is also decreased by 2,000, which makes the new balance for that account 24,500. Transaction 9, received a check as partial payment on account for $450. So now the bank has $450 more than it did before, but it also decreases the accounts receivable account because they no longer owe that. And here we go. So cash in bank is increased by $450, making the new balance for that account $76.50. Accounts receivable is minus $450, that's $13.50, and the other accounts remain unchanged. So that's your study guide. Make sure you know how to do these things. If you have any questions, reach out. Make sure you review before the test. Thank you and have a fabulous day.